17 March, Friday, guys, MEO with Cal once again. Now, has the Fed decided to let the bulls return? Well, apparently this is what's happening right now. You can see that across the board, many YouTubers are calling for buy right now. Why? Because Federal Reserve has just increased their balance sheet by $300 billion again. My God, I mean, they were doing QT, right? They were cutting at what, 50 billion, 25 billion progressively for months, and now suddenly they just pump it up by 300 billion. This is really incredible. So of course, we all know that what will happen next. That means that printing of money has to begin, and of course inflation will go up. That's the only way. So what will happen? I don't know. I'll tell you more in details through some of the experts that I gathered for you. But once again, guys, make sure that you do your risk assessment, and thank you, AIMS, for the kind sponsorship. Now, my preview has left 5 slots, okay? 5 slots. That means that we hit 115 people. Thank you guys once again. Really appreciate that. My preview come market outlook will be tomorrow, 18 March at 9:30 a.m. to 11:30 a.m. So don't be late, guys. Wake up a bit early. Prepare for yourself. Now, we have already started to send out the Zoom addresses to you guys that we send twice, today and tomorrow, so that make sure that you get it. Right? If you still don't get it by tomorrow, then you have to quickly PM us through the Facebook Messenger, and we quickly will try our best to assist. But of course, with 100 people coming in, we're probably going to have a bit of an admin issue, yeah? So guys, thank you once again for the great support. Now tomorrow, we will talk about how low the Dow could possibly go, or how high the Dow will go now, since everybody's so bullish right now. And of course, we'll take about when it's a good time to buy some gold and some crude oil. In fact itself, right, gold, it looks good, okay? And in fact itself, I am expecting gold to go to 2218, but I don't think it will happen so fast. I think that there's something that must break first before we can see that. I'll tell you more tomorrow, yeah? And of course, the 3 Singapore stocks that I will recommend to you to buy and hold. Now, this one is for long-term investment for 6 months to 8 months duration period. So we'll talk about that tomorrow. Okay, so it's going to be very impactful stuff, and I added on something more for you tomorrow. All right, so let's recap what happened last night. Okay, first of all, we can see that the Dow basically added 371 points overnight. Okay, I think there's some PowerPoint issue. Just give me a moment to just alter this for a short while. Yep. Okay, here we go. Okay, so first of all, right, the Dow up by 371, but the Nasdaq was incredible, up by 330 points, 2.7% rally. My God, in a single day. So you can see that it's very clear that it is the plunge protection team that came in. Google, Meta, Microsoft, all up by 4% on average, okay? Only Apple, very interesting, up by only 1.87%. That's something that I don't buy it. But you look at AMD, Nvidia, up by 5% and 7%. Guys, I mean, seriously, the reason for buying is because they feel that now that Federal Reserve is going to slow down interest rate. Do you think so? I don't think so, guys. It will be a 25 basis point. It's just that the market got a panic mode, a lot of short sellers, hence therefore, that's what's happening. But nonetheless, based on what we're seeing right now, is that because there's a group of banks coming into aid First Republic with $30 billion in deposit to show their confidence on the banking system. Now, this is something that I never expected. I know that the Federal Reserve will likely to come and save the day, but I never expect the banks will come in to help out one another. Well, it looks good. When you do that, and of course, if everybody stands on the same side to buy against the short sellers, naturally, the buyer will win for the day itself. But the question is, will this 30 billion be enough for First Republic? That's the first thing. And of course, we all know that this Swiss National Bank is going to come in with 50 billion franc, which is about 54 billion US dollar. Now, I also question this, will that be enough? Tomorrow's preview, I'll tell you, in my opinion, it's not enough. I'll tell you why with numbers, and you will make your own decision from there as well. So join my preview, very important. Okay, and the thing is this, now the market is being pushed up. There's that push-pull in the market right now, because now the regional bank crisis is a huge negative for the economy, but because of that, everybody want to be hero right now to save the day. So the Fed tightening process now, would it stop? No, I think they'll continue because they know they have to continue, but they'll find another way to be creative to help one another. That's pretty cool. So that's the reason why the bulls might be coming in if you look at it. Now look at the yesterday's data. The initial jobless claim is 192,000. Now the consensus is 205. That means that there are lesser people jobless. Now, that is not a good sign that what Federal Reserve want. But again, because yesterday is flooded with all the banking issues, right? So basically, no one really looked at it. And of course, the Philadelphia Fed Manufacturing Index, wow, look at it. It slowed down to 23.2. That's a big pullback. And again, that is again telling you that now we have a very strong jobless claim number. In a way, strong means lesser people getting jobless. And of course, we have the Philadelphia Manufacturing Index itself is going down, which means that recession is really around the corner, but the market doesn't care. And because today is quadruple witching. Now today is the first quadruple witching, and that is whereby the stock index futures, stock index options, stock options, and single stock futures expire simultaneously. Now according to source, right, today's number will even be bigger than the last quadruple witching. And the last one was really quite big. It's like near $1.7 trillion worth. So today, maybe we see 2 trillion. Who knows? But the thing is this, if it's so big itself, what do you expect from the market? Volatility, all right? Heavy volatility. Now, usually this will happen either in the very part of the morning or for US market. If not, right, it will happen to the midday itself. So depending what time they want to do the rolling and stuff like that, do expect the market to be very choppy today, yeah? And some more today is, of course, today is a Friday, so no one really will take position overnight. So again, all these, just take notice of that. Now, one thing is that the short sellers are doubling down on some European bank, and a lot of people thought it's Credit Suisse, right? No, apparently it's all right. There are people who are sitting on $2 billion profit by betting against the European banking sector, all right? And the thing is not Credit Suisse was the number one spot. In fact, it's BNP Paribus. Oh my goodness. Now, actually, I've been telling people around me that another company, another bank may be in trouble. And since the media have picked it up in a way, I can only say that, right, BNP Paribus must be heavily watched, huh? Because now, apparently, right, they have yield for the short sellers nearly $357 million in profit, okay? Because they've been shorting the market. And now I'll give you a top 5. You can see that Unique Credit is a second in line, HSBC third. Very interesting. Credit Suisse is only $78 million. Of course, this is just only by the S3 partners who come up with this figure, but that's why I feel that this BNP Paribus itself is something that I really want you to take notice of that, right? So tomorrow, during my preview, I'll tell you more about BNP Paribus, okay? You will be very stunned by certain numbers. All right, so we all know that US is trying to save the day. I got 3 videos for you back to back. I want you to watch them and hear for yourself what is happening. All right, let's go. All right, first video is actually from here. We have from Bloomberg. Let's see what has been. Right, go.
We've got some breaking news that indeed the US is pushing First Republic to be rescued with banks after the stock slump. So we still see First Republic stock down some 20% on the day. We're seeing a slight recovery as Bloomberg is reporting that the United States, so officials are pushing First Republic for rescue with banks after the stock slump. And fascinating the speed with which this continues to envelop regional lenders.
Yeah, and Bloomberg reporting it's all the banks you'd expect, right? JP Morgan, Citi, Bank of America, Morgan Stanley are all part of those discussions, according to sources.
All right, so what you can see is pretty clear. The main thing is that now the US trying to save the Republic Bank. And of course, now the thing is that the financial institution comes in again to save, and they are putting money together. I want you to hear live from all these people, and you tell me what do you feel at the end of the day, okay?
Back, we have more breaking news on the First Republic cash infusion. Let's get to David Faber. David, what are you hearing?
Well, Kelly, following up on a story that we brought you earlier towards the end of the noon hour, we can give you more details on this potential, I guess you want to call it a rescue plan. Maybe you do. Maybe some others want to. So we'll use that name. I'll call it also this bank consortium deposit plan. How's that? And it is now going up. I had originally said perhaps more than or roughly 20 billion. But there are more banks and more commitments to what is expected to be, again, an uninsured deposit by all these banks. Bank of America, Wells Fargo, JPM, Citi, all I am told by the many people who seem familiar with this now, at 5 billion. Morgan Stanley, 2.5. Interesting to note, no word on Goldman Sachs. Truist, PNC, US Bancorp, I think it's MMT. Is it M&T? Capital One, all in for $1 billion. Add it up, you get to about 27.5 right there. Kelly, and perhaps there will be more. The Fed and the Treasury have been coordinating this unusual.
All right, so you saw something there. You heard it? Yes, indeed. Goldman Sachs is not around. Why? Why wouldn't Goldman Sachs be around? Your guess is good as mine. All right, so we all know that the Federal Reserve now has increased their balance sheet by $297 billion. I mean, why are they doing this right now? I thought they want to do more QT to basically cool down the economy. Yes, we know the US banking sector itself is in trouble, but didn't Yellen say that everything's all fine? Do remember this guy. Yellen was the same person who tell you that everything is okay with inflation. And when inflation hit the fans, she says that, it's because of this, because of that, blah, 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 blah. Jerome Powell, he says that it is actually due to this inflation, a problem itself, right, that causes it, but it will be transitory. But for 1.5 years, transitory, and now they realize it. They say that it's okay, it's part of the QE, so that's why we'd accept it. All right, once again, all these information is coming in right now. It's kind of cool, right? Let's watch this.
To Steve Leisman, who has breaking news on the Fed. Steve.
Thank you, Morgan. We have the Fed's balance sheet for the week ending this past Wednesday, and it is up by $297 billion as a result of a couple failed banks, as a result of borrowing at the discount window. Borrowing at the discount window rose by $148.2 billion. And then this new program that the Fed launched on Sunday in order to provide par value for high quality collateral to the banks, it rose by first time borrowing. It's $11.9 billion was borrowed by banks from this new Fed lending facility. Half of this increase, this $297 billion, is linked to bridge loans that the Fed, when there is a bank failure, normally provides and is guaranteed by the FDIC. So this number here, Morgan, we do not know if it reflects one bank, two banks, three banks, a whole bunch of banks borrowing the discount window. We're going to have to wait to see, now that these two particular banks were closed, whether or not this lending at the window, which can be a sign of stress or it can be a sign of banks just trying to liquefy themselves and get ready for any deposit withdrawals, if it continues into the week. But right now we know there was a good amount of takedown of borrowing at the Fed's emergency discount window and some borrowing at the new facility. Morgan?
So how does this speak to this discussion that's afoot right now about everything that's going on in banking and this idea of liquidity crisis and whether it's very serious, whether it's potentially systematic or systemic, I should say, or whether it really will be confined to just a handful? It's still too soon to know.
It's just difficult to know right now. We know there was a lot of borrowing at the window. For example, there was something like $4.5 billion of discount window borrowing in the week before this past week.
Okay.
And now it's 100 and something billion, 148 billion. So that's a big increase right there. And so the issue being, was it one bank, two banks? Was it a single bank or two banks that were trying to liquefy themselves, or was it multiple banks? There's transparency by the Federal Reserve around the borrowing at the window, but not enough to know how widespread the issue is.
Steve, what kind of a position does this put the Fed in? It's been trying to reduce its balance sheet along with get rates higher, but things happen.
It does happen. I think the key here, John, and I do need to report this end of the story here. You are correct. The Fed has been trying to bring the balance sheet down, and this is a market increase in the size of the balance sheet. The question is, how much of this money actually gets into the economy? In the sense, does it become the source of loans to the economy? And I don't think that's probably what's going to happen there. To the extent that banks borrow to liquefy themselves, it's probably not going to be something that's going to create lending into the economy. It may keep the existing lending that was going to happen in place, or keep it at the prior level. But I don't know that this is going to be actually inflationary, but it depends on what happens over time. Does the progress towards reducing the balance sheet continue after this?
All right. Key questions. More will be revealed. Steve Leisman.
All right, so you hear what Steve said. It's very clear itself, in my opinion, yeah. The Federal Reserve is really preparing for something big. Now, the thing is that if you look at it right now, right, the from the first bank itself, all right, to now, I mean, the preparation is between like $20 to $30 billion. But for Federal Reserve to raise it by $297 billion, seriously, it's just telling me that they are preparing for something big. That means that something is going to be hit, and they're trying their best to ensure that enough liquidity later. That is my point. So why would the Federal Reserve suddenly increase it by 300 billion? Most probably they already know that someone is going to get into trouble, and of course that will have a widespread of issue coming in. This is how I feel it. If you actually, if you agree with me, please put it in the comment box. I want to hear what you have to say, all right? So with all that, with due respect itself, right? So now the thing is this. Let's do something very technical, right? Let's take a look. It seems that right now, right? It seems that right now, right, the market was actually looking at a rate cut, right? So we were looking at 50 basis points for March. Then because of this SVB thingy, and then the banking sector get hit, so now 50 basis points no longer on the table. Then the market was looking at 25 basis points. But because of the whatever is having cascading downwards, right? So what happened is that people say that no, let's go at no interest rate instead. But now you can see the last 2 days, the market is turning up again because we have ECB now increasing interest rate by 50 basis points because they tell the market that look, we must continue to do the rate hiking while we prepare for whatever due to come. I think that should be the right strategy in my opinion. So whether or not will Federal Reserve follow through, I think they will, because that should be the right way. You cannot solve them together, all right? But of course, Wall Street really want the Federal Reserve to really cut interest rate, because if you remember this, it was the same reason why SVB went down. So imagine if SVB went down and then we have First Bank coming down and so many banks, the smaller ones, is actually doing this. So it's like pretty clear that the bigger boys are also doing that. Don't you agree? You can't be the small bank is smart enough guys who will be doing this. I'm pretty sure all the banks during the 2020 to 2022, when the free money was going everywhere, there's so much money in the market, trillions and trillions of dollars, there must be somewhere they put the money. And of course, back then itself, the safest obviously was the bond market, which was a very, very high price. Think about this for a while, okay? So now we look at the current forward PE ratio. We can see that we are off from the highest point back then in 2022. We were at a very ridiculous level. That was where I called for sell, and indeed the market collapsed all the way in the forward PE ratio. But the good thing is that now it's come to the point whereby usually it actually calls for buy. But the bad thing is that, right, if you look at it, we need to go down further. I think that we need to go down to the low, like the 16 level. That is where usually the low is, okay? So you remember that was where the 2019, the market basically recovered and went all the way up. And back then itself in 2014, that was the start of the bull market after the initial, after the pandemic, after the Lehman Brothers crisis, then it recovered. So if you look at it, right, it is better for the forward PE ratio to hit 16 than you go to buy, and which means that we still got a bit of room because we are now at about 18 level, right? So on top of that, you can see right now the S&P profit margin, all right, versus the unit labor cost year on year. Well, you have a very interesting thingy that now the numbers are showing that unit cost is going down, while that is in 2024. But for 2023 itself, it's actually increasing. And of course, now people are looking at the profit margin to increase. But the problem is, if the margin doesn't increase at all, while the labor cost is going up, right, then naturally we are heading towards a recession. So once again, it's depending how you see this thing. But to me itself, right, this bank sector problem, which you saw shares from $100+ drop all the way to $20, right? You must understand it lost basically 80%. So even at $20 now, if you rebound by 20%, it's only $4 upside. So you must understand the difference in percentage, right? Yeah. So then what to expect now is basically technical. So later on in my technical video, I'll tell you more in details, and I wish you the best for trading. Remember today's quadruple witching day. Go slow. Take care and have a good weekend. I'll see you tomorrow for my preview, guys. Bye-bye.